Listen to me very carefully, because I'm only going to say this once and I'm not going to sugarcoat a single syllable of it. The system that has kept your dollar valuable, the system that has allowed the United States to run trillion-dollar deficits without consequence, the system that has quietly underpinned every stock in your 401 kilobits, every bond in your retirement account, every dollar of savings you think you have sitting safely in a bank, that system is dying right now in real time while you are distracted watching news anchors argue about things that do not matter. I have spent decades moving billions of dollars through global macro positions, and I can tell you with absolute certainty that what is unfolding right now is not a blip. It is not a correction, and it is not something you wait out. It is a 50-year structural shift in the global monetary order, and if you are not positioned for it, you will not just miss the opportunity, you will be financially destroyed by it. You have two choices. Wake up right now and act like a serious person, or stay asleep and find out the hard way what happens when the most powerful financial system in human history unravels underneath your feet. If you are serious about your financial survival, and I mean genuinely serious, not I'll think about it serious, you subscribe to this channel right now. The analysis I'm giving you in this video would cost you $50,000 in consulting fees at any serious macro firm. I am giving it to you for free because financial illiteracy is a disease, and I refuse to watch another generation of ordinary people get wiped out by a system they were never taught to understand. Hit subscribe. Do it now, before we go any further, because everything I'm about to tell you is going to matter for the next decade of your financial life. Now let me teach you something that most people, including most people who call themselves investors, fundamentally do not understand. To understand why the petrodollar dying is catastrophic for unprepared investors, you have to understand what the petrodollar actually was and what extraordinary, almost incomprehensible power it gave the United States for the last 50 years. It begins in 1974. The United States, under Nixon and Kissinger, had already made one of the most consequential financial decisions in modern history in 1971, abandoning the gold standard. When Nixon closed the gold window, the dollar was suddenly backed by nothing tangible. It was backed by faith, by guns, and by geopolitical leverage. The problem was, faith is a fragile thing, so Kissinger flew to Riyadh and made a deal with Saudi Arabia that would redefine the global financial order for the next 5 decades. The deal was elegant in its ruthlessness. Saudi Arabia would agree to price all of its oil exclusively in US dollars. In exchange, the United States would provide military protection and security guarantees to the Saudi regime. That was it. That was the entire architecture of petrodollar dominance. Now here is why that deal was the most powerful financial move in the 20th century. Oil is not optional. Every economy on Earth needs oil to manufacture, to transport, to heat, to power industry. If you need oil, and oil can only be purchased in dollars, then every single nation on Earth must hold US dollars in reserve. They cannot opt out. They cannot use their own currency. They must accumulate dollars. And what do you do when you hold large quantities of dollars? You do not stuff them under a mattress. You buy US Treasury bonds, US government debt, because at least that way your dollars earn interest. The result was a permanent, structural, globally mandated demand for US government debt. Every country on Earth became a forced buyer of American IOUs. That demand kept US interest rates artificially low. It allowed the US government to spend vastly more than it collected in taxes, year after year, decade after decade, without triggering the inflation or the currency collapse that would have destroyed any other nation operating with those same deficits. The petrodollar was the financial equivalent of being able to print money and have the entire world agree to treat it as real. That is what was built in 1974, and that is what is now being dismantled. Here's where I need you to stop thinking like a retail investor and start thinking like a macro strategist, because the death of the petrodollar is not a future event. It is a present tense reality that is already reshaping global trade flows, treasury markets, and currency valuations right now. As you watch this video, let us start with the numbers, because numbers do not have feelings and they do not lie. The BRICS nations, Brazil, Russia, India, China, South Africa, and now a rapidly expanding list of additional members, collectively represent over 40% of global GDP and more than a third of global oil production. These nations have been systematically, deliberately, and successfully reducing their dependence on the US dollar in bilateral trade. China and Russia are settling energy transactions in yuan and rubles. Saudi Arabia, yes, the same Saudi Arabia that created the petrodollar deal with Kissinger, has been openly discussing accepting yuan for oil sales to China, which is its largest customer. India is buying Russian oil in rupees. The architecture of dollar-only oil transactions, which Kissinger built in 1974, is fracturing along every seam simultaneously. Now, what does that mean mechanically for your money? Here's the transmission mechanism. And I want you to follow this chain of causation carefully because it ends at your 401 kilobits. When nations no longer need as many dollars to conduct global trade, they no longer need to hold as many U.S. Treasury bonds. When they stop buying treasuries, or worse, when they begin actively selling them, the price of those bonds falls. When bond prices fall, yields rise. When yields rise, interest rates across the entire economy increase. When interest rates increase, the present value of every stock in the market drops because future earnings are discounted at a higher rate. This is not speculation. This is the arithmetic of financial markets, and the math right now is not friendly. Consider what has already happened. Foreign central bank holdings of U.S. treasuries have been declining. China alone has reduced its treasury holdings significantly over the past several years, from over $1 trillion to levels not seen since the early 2010s. Japan, the largest foreign holder of U.S. debt, is under its own domestic pressure to raise rates and sell foreign assets. The structural buyer that kept the treasury market liquid and U.S. rates suppressed is disappearing. And the U.S. government, rather than shrinking its deficit to compensate, is running deficits of $1.5 to $2 trillion per year. You do not need to be a macroeconomist to understand what happens when supply of debt goes up and demand for that debt goes down. The price collapses, and when the price of U.S. government debt collapses, it takes everything else down with it. The Middle East is not the main story here. Everyone watching the Middle East is watching the wrong movie. The main story is monetary. The main story is that the 50-year agreement that forced every nation on earth to fund American government spending is unwinding, and the bill is finally coming due. Now I want to take you somewhere that most financial commentators are completely ignoring because they are still fixated on the Middle East, on oil pipelines, on OPEC output targets, all things that mattered in the old paradigm, the smart money, and I mean institutional money, macro fund money, sovereign wealth fund money, is looking at a map that most retail investors have never even considered. It is looking at the Western Hemisphere. It is looking at the Caribbean. And specifically, it is looking at Cuba and at what a geopolitical pivot toward Cuba would mean for the global critical minerals race. Let me give you the raw facts on Cuba because most people genuinely do not know this, and ignorance here is expensive. Cuba sits atop some of the most significant untapped mineral deposits in the entire Western Hemisphere. Cuba is the fifth largest cobalt reserve in the world. Cobalt is not a luxury mineral. It is a mandatory input for lithium-ion battery production, which means it is a mandatory input for every electric vehicle, every grid-scale battery storage system, and every military drone platform being manufactured today. Cuba also holds enormous nickel reserves. It was historically one of the world's top nickel producers, along with significant copper deposits and meaningful gold and silver resources. The reason these reserves are largely underdeveloped is not geological, it is political. Decades of U.S. embargo combined with the catastrophic economic mismanagement of a economy have left Cuban mining infrastructure operating at a fraction of its potential capacity. Now layer on top of that what is happening geopolitically. The United States effectively cut off Cuba's two primary economic lifelines simultaneously. Venezuela, under U.S. pressure and its own internal political shifts, is no longer reliably supplying Cuba with subsidized oil. The energy lifeline that kept the Cuban economy from total collapse for decades. Iran, which had been providing financial support and diplomatic backing to Havana, is increasingly isolated and incapable of sustaining that relationship. Cuba is being economically cornered, and a cornered government facing genuine economic collapse becomes negotiable. The same playbook was run in Venezuela, where a regime transition, whatever you think of how it was achieved, suddenly opened up Venezuelan oil fields, which contained the world's largest proven oil reserves, to U.S. energy companies and U.S.-aligned infrastructure investment. The pattern is deliberate and it is accelerating. The United States is executing what serious geopolitical analysts are calling a nearshoring or reshoring strategy, pulling critical supply chains back into the Western Hemisphere, away from China, away from the Middle East, and into regions where U.S. military, diplomatic, and economic leverage can guarantee access. Cuba fits this strategy perfectly. It has minerals. It is 90 miles from the Florida coast. It is broke. And the U.S. has demonstrated repeatedly in this hemisphere that it knows how to apply the combination of economic pressure and political leverage necessary to change the operating environment. If Cuba opens, and I'm talking about genuine economic opening, not tourism-level engagement, but real mining concession and infrastructure investment, access, the company's position in Caribbean basin mining, in Latin American infrastructure construction, in critical minerals processing, will be among the best performing equities of the next decade. That is not a prediction of next quarter's earnings. That is a structural 5 to 10 year macro thesis that the institutional money is already beginning to price in, while the retail investor is still watching oil prices in Brent crude. Now I want to be brutally direct with you about what the death of the petrodollar means for the specific financial instruments that most ordinary Americans are sitting in right now, because I am tired of watching people sleepwalk into financial destruction that was entirely foreseeable and entirely preventable. If you own long-duration U.S. Treasury bonds, and you may own them without knowing it, inside a target date fund in your 401 kilobits, inside a conservative managed portfolio, inside a bond index fund, you are holding one of the most dangerous assets in this environment. Long-duration bonds are mathematical time bombs when inflation is elevated and when the structural buyer of those bonds is disappearing. Here is the arithmetic. When interest rates rise by 1%, a 20-year Treasury bond loses approximately 15% to 18% of its market value. When rates rise by 2%, which is not a radical scenario given the fiscal trajectory of the United States, you are looking at a loss of 30% or more on an asset that most people believe is safe. There is nothing safe about an asset that loses a third of its value while inflation simultaneously erodes the purchasing power of the dollars it pays you. You are being destroyed on two fronts at once, and you are doing it to yourself because no one ever taught you how these instruments actually behave. The US dollar itself is another position that most Americans are unknowingly overexposed to. Your salary is in dollars. Your savings account is in dollars. Your money market fund is in dollars. If the dollar loses 20% of its international purchasing power over the next 5 years, which is a conservative estimate given the trajectory of U.S. fiscal deficits and the structural reduction in foreign demand for dollar-denominated assets, then everything you have priced in dollars is worth 20% less in terms of what it can actually buy in the real world. Inflation is not an accident. It is the predictable mathematical consequence of a government that can no longer fund its deficit through foreign demand for its bonds and must therefore print that debt through the Federal Reserve. You are already living through the early stages of this process. What you have experienced in grocery stores and housing markets over the past 4 years is not an aberration that will self-correct. It is the beginning of a structural trend. Your 401 kilobits, if it is sitting in a conventional balanced portfolio of U.S. stocks and U.S. bonds, is exposed to both of these risks simultaneously. Bonds will get hit by rising rates. Equities will get hit by rising rates and by the multiple compression that comes when the cost of capital increases. You are not in a safe harbor. You are in the direct path of the storm, and believing that your portfolio is diversified because it holds both stocks and bonds is one of the most dangerous financial misconceptions of the modern era. Because in a rising rate, inflationary environment, stocks and bonds fall together exactly as they did in 2022, exactly as they will again. So let me now tell you what Wall Street is actually doing, because I promise you it is not what the financial media is telling you to do. The institutional money, the macro funds, the sovereign wealth funds, the endowments that manage money with 50-year time horizons is moving into hard assets with a focus and a velocity that I have not seen since the early 2000s commodity supercycle. Hard assets are the only category of investment that has historically maintained and grown its real purchasing power during periods of currency debasement and structural monetary transition. When the dollar weakens, the dollar price of hard assets rises not because the assets themselves became more valuable in absolute terms, but because it takes more debased currency to buy the same unit of real stuff. Gold is the most obvious expression of this dynamic, and it is already telling you exactly what the smart money thinks about the dollar's trajectory. The gold price is not rising because people suddenly rediscovered an interest in shiny metal. It is rising because institutional capital is systematically moving out of dollar-denominated financial assets and into assets that cannot be printed, cannot be defaulted on, and cannot be inflated away. But gold is only the most visible tip of the hard asset iceberg. The deeper opportunity, the one that institutional money is positioning for aggressively right now, is in the critical minerals and the companies that extract them: cobalt, nickel, copper, lithium, rare earth elements. These are the inputs to the physical infrastructure of the 21st century economy. Every electric vehicle requires them. Every military drone requires them. Every AI data center requires copper for power transmission at a scale that most people have not begun to internalize. The AI build-out alone is projected to require a tripling of U.S. electricity transmission infrastructure over the next 15 years. Copper does not become optional when you decide to build a data center. It becomes more mandatory than it has ever been. The framework I use, and it is a framework, not a feeling or a guess, is to follow the flow of institutional capital into the sectors being driven by structural, multi-year macro forces, and then identify the companies within those sectors that have the earliest and the most leveraged exposure to those forces in the mining sector. That means looking at junior and mid-tier producers with assets in the Western Hemisphere, specifically Caribbean Basin. Exposure, given the geopolitical thesis I outlined, it means understanding balance sheets, production costs, and reserve quality, not just stock price momentum. In the infrastructure space, it means identifying the engine, construction, and logistics companies that will be contracted to build the ports, the processing facilities, and the supply chain networks that the reshoring strategy requires. These companies will not be the ones featured on financial television next week. They will be the ones that institutional analysts are modeling in spreadsheets right now, building positions in quietly before the narrative becomes mainstream and the retail money floods in, at which point the opportunity is already largely gone. The service companies, the equipment providers, the specialty chemical suppliers, the logistics operators that support the mining and infrastructure sectors represent another layer of the opportunity with typically lower risk profiles and more predictable cash flows than the pure mining plays. The framework always involves looking at the entire value chain, not just the most obvious headline play, because the most obvious play is where the retail money goes, and the retail money with respect is usually late. Understanding when to enter is as important as understanding what to enter. The institutional approach to entry is not based on reading headlines or waiting for analyst upgrades. It is based on monitoring volume flows, capital allocation signals from sector rotation data, and the behavior of options markets. the places where the smart money leaves its footprints before the mainstream narrative catches up. When you see volume expanding in a sector that the financial media is still largely ignoring, that is your signal. When you see institutional accumulation in a beaten-down commodity producer while retail sentiment is still bearish, that is your signal. The retail investor who waits for confirmation, who waits until everyone is talking about Cuban minerals on CNBC, will buy at the top and hold through the inevitable correction. The investor who learns to read institutional flows will have been accumulating for months before that conversation ever hits the mainstream. Let me be absolutely explicit about what I am not telling you to do. I am not telling you to liquidate everything and chase the latest hot sector. I am not telling you to put your entire retirement account into speculative mining stocks. What I'm telling you to do is to conduct a ruthless, honest audit of what you currently own. Understand what macro environment those assets are built to perform in, and ask yourself with total honesty whether you believe that environment is the one we are currently entering. If you own long-duration bonds expecting a deflationary, low-rate environment, you are wrong about the environment. If you own a dollar-heavy cash position believing that the purchasing power of that cash is being preserved, you are wrong about the purchasing power. The correction to those positions does not require speculation. It requires reallocation into assets that perform in the actual environment we are in, which is an inflationary, dollar-weakening, hard, asset-driven macro cycle that has barely begun. I'm going to close this with something I say to everyone who has ever worked for me, and I mean it with the same force now that I meant it then. The market does not care about your feelings, your political opinions, your discomfort with change, or your preference for things to be simpler than they are. The market is a ruthless transfer mechanism. It takes money from people who do not understand what is happening and gives it to people who do. That is the only function it has ever served, and it will continue to serve that function with perfect indifference to your personal situation. The petrodollar system is dying. The evidence is in the Treasury market data, in the BRICS trade settlement numbers, in the gold price, in the geopolitical moves being made in the Western Hemisphere right now. You can choose to engage with that reality and position accordingly, which requires effort, education, and the willingness to think differently from the financial media consensus. Or you can choose to ignore it and find out in 3 years, or 5 years, or 10 years what it costs to be the person who had all the information, did nothing with it. Subscribe to this channel right now, because this is where the macro analysis happens, not the sanitized, conflict of interest-laden analysis that Wall Street sells to keep you in the products that are profitable for them, but the cold, direct, institutional-grade analysis that gives you a real chance to protect and grow what you have built. Share this video with one person in your life who you believe is sitting in the wrong assets for this environment. Because the greatest act of financial generosity right now is cutting through the noise for someone who does not yet know they are in danger. The wealth transfer I have described in this video is not hypothetical. It is underway. The only question that remains is which side of it you end up on.